Assalamualaikum and good morning everyone. My name is Jumasna Binti Kahar and today I will be presenting my individual assignment for the course APT50703, which is the risk management. The title of my presentation is a critical analysis of credit risk management in Malaysian financial institution, a case study of Maybank. This presentation focuses on how credit risk managed within Malaysian financial institution by examining Maybank as the selected case study. Throughout this presentation, I will discuss the concept of credit risk, explain the regulatory framework established by Bank Negara Malaysia, analyze Maybank credit risk management practices, identify the key challenges faced by financial institutions, suggest future improvement, and finally discuss the Islamic perspective on risk management. I hope this presentation provides a clear understanding of the importance of effective credit risk management in ensuring financial stability and sustainable banking practices. So, let us begin with the introduction. Now, let us begin with the introduction. Firstly, it is important to understand the meaning of credit risk. Credit risk refers to the possibility that borrower or counterparties fail to fulfill their financial obligation according to the agreed contractual terms. In other words, it is the risk that a borrower may be unable or unwilling to repay a loan or financing provided by the financial institution. Because of this, effective credit risk management is extremely important. It helps financial institutions maintain financial stability by identifying, assessing, monitoring, and controlling potential credit losses. At the same time, good credit risk management supports sustainable banking operation and protect both the financial institution and its customer. However, if credit risk is not managed properly, it may result in several negative consequences. These include an increase in non-performing loans, significant financial losses, lower profitability, and a decline in public confidence toward the banking sector. Therefore, managing credit risk effectively is essential to ensure the long-term stability of financial institutions. Finally, the objective of this presentation is to analyze credit risk management practices in Malaysian financial institutions. Specifically, this presentation discusses credit risk measurement methods, the regulatory framework established by Bank Negara Malaysia, and examine Maybank's credit risk management approaches during COVID-19 pandemic as the selected case study. Moving on the next slide, I will explain the main component of credit risk. Understanding this component is important because they help financial institutions identify where credit risk may arise and determine the appropriate risk management strategy. The first component is counterparty risk. Counterparty risk refers to the possibility that one party involved in a financial transaction fails to fulfill its contractual obligation. This can affect various financial agreements, including loans, financing contracts, and other banking transactions. The second component is default risk, which is one of the most common forms of credit risk. It occurs when borrowers are unable or unwilling to repay their loans or financing according to the agreed repayment schedule. As a result, financial institutions may experience financial losses and an increase in non-performing loans. The third component is credit exposure. Credit exposure represents the total amount of potential financial loss that a bank may face if a borrower defaults on their repayment obligation. The higher the credit exposure, the greater the potential financial impact on the institution. Finally, understanding this component is essential because they enable financial institutions to identify, measure, monitor, and manage credit-related risks more effectively. By analyzing these different aspects of credit risk, banks are able to make better financing decisions, minimize potential losses, and maintain long-term financial stability. Now, let us move on to the credit risk measurement method used by financial institutions. To manage credit risk effectively, banks use several measurement methods to evaluate the likelihood of borrower default and estimate potential financial losses. These methods support better financing decisions and help financial institutions minimize credit-related risk. The first method is the credit rating system. This system evaluates a borrower's creditworthiness by classifying borrower into different risk categories based on their financial condition, repayment history, and overall credit profile. A higher credit rating generally indicates lower credit risk. The second method is the credit scoring model. This model assesses a borrower repayment capability by analyzing financial information, credit history, income level, and other relevant factors. Credit scoring enables banks to make financing decisions more efficiently and consistently. The third method is the probability of default or PD. This measures the likelihood that a borrower will fail to meet their repayment obligation within a specific period. A higher probability of default indicates a greater level of credit risk. Next is the exposure at default, commonly known as EAD. This method estimates the total amount of financial exposure that the bank may face if a borrower defaults. It helps financial institutions understand the maximum potential exposure at the time of default. The final method is loss given default, or LGD. LGD measures the percentage of financial loss that a bank is expected to incur after considering any recoveries, such as collateral or repayment collection. It provides an estimate of the actual loss the bank may experience after a default occurs. Overall, these credit risk measurement methods provide financial institutions with a comprehensive understanding of potential risk. They support accurate risk assessment, improve financial decisions, and ultimately contribute to maintaining the stability and sustainability of the banking sector. Having discussed the measurement method, I will now move to the section which is explain the credit risk management strategy implemented by financial institutions. Moving on the next section, I will explain the credit risk management strategy adopted by financial institutions to minimize credit risk and maintain financial stability. The first strategy is credit limits. Financial institutions set credit limits to control the amount of financing provided to individual borrower, business sector, or industry. This helps prevent excessive credit exposure and reduce concentration risk, ensuring that potential losses are not heavily concentrated in one customer or sector. The second strategy is collateral management. Banks require borrowers to provide collateral such as property, fixed assets, or other securities to secure financing. If the borrower fails to repay the financing, the bank can recover part of the losses by liquidating the pledged collateral. Therefore, effective collateral management helps reduce potential financial losses. Another important strategy is portfolio diversification. Instead of concentrating financing in a single industry of borrower group, banks diversify their financing portfolio across different sectors, geographical location, and customer segments. This approach reduces overall portfolio risk because losses in one sector may be offset by better performance in others. The fourth strategy is credit derivatives. lending capacity. Finally, financial institutions implement monitoring and internal control system. Banks continuously monitor borrower repayment performance, review changes in financial condition, and identify early warning signs of potential default. Strongly internal control also ensure that financing activities comply with internal policy and regulatory requirements. Overall, this credit risk management strategy plays a vital role in supporting financial stability, reducing potential financial losses, and strengthening the resilience of financial institutions against future credit risks. Before discussing the case study of Maybank, it is important to understand the regulatory framework that governs credit risk management in Malaysia. This framework ensures that financial institutions manage credit risk consistently, maintain financial stability, and comply with international and national regulatory standards. The first framework is the Basel III framework. Basel III was introduced to strengthen the resilience of banks by improving capital adequacy, liquidity management, and overall risk management. It requires banks to maintain sufficient capital to absorb unexpected losses during periods of financial stress. The second framework is IFRS 9 and the Expected Credit Loss or ECL model. Unlike the previous incurred loss approach, IFRS 9 requires banks to recognize potential credit loss at an early stage. This enables financial institutions to identify possible defaults sooner and make more accurate provisions for credit losses. The third framework is the capital adequacy. Capital adequacy requirement. Banks are required to maintain adequate capital reserve based on the level of risk they undertake. This ensures that financial institutions remain financially sound and are able to continue their operation even during periods of economic uncertainty. Finally, in Malaysia, Bank Negara Malaysia or BNM serves as the main regulatory authority. BNM supervises financial institutions, issues credit risk management guidelines, monitors regulatory compliance, and promotes prudent banking practices to safeguard the stability of the Malaysian financial system. Overall, this regulatory framework provides the foundation for effective credit risk management by strengthening financial resilience, improving risk governance, and supporting sustainable banking operations. Next, I will present the case study of Maybank and discuss how this credit risk management principles are applied in practice. Now, I will move on to the case study of Maybank, which is the focus of this presentation. Maybank was selected because it is the largest banking institution in Malaysia and one of the leading financial groups in Asia. With operations across multiple countries, due to its large financing portfolio and diverse customer base, Maybank provides a suitable example for analyzing how credit risk is managed in practice. During the COVID-19 pandemic, the banking industry experienced significant economic disruptions. Many individuals and businesses faced reduced income and cash flow difficulties, making it more challenging for borrowers to meet their financing obligations. As a result, financial institutions experienced an increase in credit risk, particularly through higher default risk and rising non-performing loans or NPL. This condition created several challenges for both borrower and bank. Borrower experienced reduced repayment capacity due to income uncertainty, while bank faced deteriorating asset quality, increasing credit loss, and greater uncertainty in assessing borrower repayment ability. To address these challenges, Maybank implemented various credit risk management measures, including enhanced borrower monitoring, loan restructuring and repayment assistance program, as well as strengthening credit assessment and risk monitoring processes. This initiative helps support effective customer while maintaining the bank's financial resilience during the crisis. Therefore, the case study demonstrates the importance of effective credit risk management in helping financial institutions respond to economic shock, minimize financial losses, and preserve long-term financial stability. In the next slide, I will explain the specific credit risk management, a process implemented by Maybank during the period. Now, I will explain the main credit risk management approaches implemented by Maybank during the COVID-19 pandemic. The first approach was loan moratorium assistance. During the pandemic, many individuals and businesses experienced financial difficulties due to reduced income and economic disruption. To support effective customers, Maybank provided temporary repayment relief through the loan moratorium program. This initiative helped borrowers match their financial obligations while reducing the immediate risk of loan default. The second approach was credit monitoring and assessment. Maybank continuously monitor borrower financial condition and payment behavior to identify customer-facing financial stress. Through regular credit assessment, the bank was able to detect early warning signs of default and take appropriate action before credit problems become more serious. The third approach was one is restoring and rescheduling instead of immediately classifying financially distressed borrower as default cases. Maybank revised financing terms by extending repayment periods, adjusting installment amounts, or restructuring financing facilities according to customer repayment capacity. This approach supported customers while maintaining the quality of the bank financing portfolio. The fourth approach was provisioning and capital buffer strategy. In accordance with regulatory requirement and IFRS 9, Maybank strengthening its financial reserve by recognizing expected credit losses and maintaining adequate capital buffer. This ensured that the bank remained financially resilient even if credit losses increased during the pandemic. Overall, these approaches enable Maybank to balance customer support with prudent risk management by combining repayment assistance, continuous monitoring, financing, restructuring, and strong capital management. The bank successfully maintained financial stability while reducing credit risk exposure throughout the crisis. Next, I will discuss the critical analysis of Maybank credit risk management practices by highlighting its strengths, limitations, and future challenges. After examining Maybank credit risk management approaches, this section provides a critical analysis of the overall effectiveness by highlighting the strength, weakness, lessons learned, and future implications. Firstly, Maybank demonstrated several important strengths during the COVID-19 pandemic. One of its key strengths was its strong credit monitoring system, which enabled the bank to identify borrowers experiencing financial difficulties at an early stage. This allowed timely intervention before repayment problems become more severe. Another strength was the bank's effective borrower assistance program, including loan moratoriums and financing restructuring. That initiative helped customers overcome temporary financial difficulties while reducing the likelihood of large-scale loan defaults. In addition, Maybank maintained a strong capital position by strengthening provision for expected credit losses and maintaining adequate capital buffer. This enhanced the bank's require additional resources, time, and operational effort. Furthermore, the overall success of the strategy was highly dependent on economic recovery. If economic conditions had remained weak for a prolonged period, borrowers' repayment capacity could have deteriorated, further leading to higher credit losses. From this analysis, an important lesson learned is that financial institutions should adopt a proactive approach to credit risk management, particularly during periods of economic uncertainty. Early risk identification, continuous monitoring, and timely borrower assistance are essential for maintaining financial stability. Overall, this critical analysis demonstrates that while having credit risk management strategy be generally effective, continuous improvement is necessary to strengthen future risk management practices and enhance resilience against future economic crises. Next, I will conclude this presentation by discussing the Islamic perspective on risk management and summarizing the key findings of the study. Finally, I would like to discuss credit risk management from the Islamic perspective. In Islamic finance, risk management is not only a financial responsibility but also a Sharia obligation. Financial institutions are expected to manage risk prudently while ensuring that all financial activities comply with Islamic principles and promote fairness, transparency, and public welfare. The first principle is prudence or ihtiyat. This principle encourages financial institutions to make courteous and responsible financing decisions before improving financing. Banks should carefully assess borrower repayment capacity to minimize unnecessary risk and protect both the institution and its customers. The second principle is justice or adl. Islamic finance emphasizes fairness in all financial transactions. Financial institutions should treat customers ethically by providing financing based on their actual repayment ability and offering appropriate assistance when borrowers experience genuine financial difficulties. This principle was reflected during the COVID-19 pandemic through repayment assistance and financing restructuring program. Another important principle is transparency in ethical governance. Islamic financial institutions are expected to maintain honesty, accountability, and transparency throughout the financing process. Clear disclosure of financing terms, responsible decision-making, and compliance with Sharia principles have strengthened public trust and improved governance. Finally, all these principles support the objective of Maqasid al-Sharia, which aim to protect wealth, maintain financial stability, and safeguard the public interest. Therefore, effective credit risk management is not only about reducing financial losses but also about achieving social justice and sustainable economic development in accordance with Islamic values. Overall, the Islamic perspective demonstrates that effective risk management should balance financial performance with ethical responsibility, ensuring long-term sustainability for both financial institutions and society. Next, I will conclude the presentation by summarizing the key findings and overall contribution of the study. Lastly, I would like to conclude my presentation. This study highlights that credit risk management plays a crucial role in maintaining the financial stability and sustainability of financial institutions. Effective credit risk management helps banks minimize financial losses, improve asset quality, and strengthen overall organizational resilience. Based on the case study of my bank, the findings show that proactive measures such as continuous credit monitoring, loan restructuring, repayment assistance, and strong capital provisioning enable the bank to manage credit risk effectively during COVID-19 pandemic. This strategy helped my bank remain financially resilient despite the challenging economic environment. From the Islamic perspective, credit risk management should not only focus on financial performance, but also be guided by the principle of prudence, justice, transparency, and maqasid al-sharia. This principle ensure that financial decisions are ethical, responsibility, and beneficial to both financial institutions and society. Looking ahead, financial institutions should continue strengthening their risk management framework by adopting proactive strategy, improving governance, and preparing for future economic uncertainties. This will enhance long-term financial resilience and support sustainable banking practice. In conclusion, effective credit risk management is essential not only for protecting financial institutions from potential losses but also for promoting a stable, responsibly, and sustainable financial system. Thank you very much for your attention. I hope this presentation has provided a better understanding of credit risk management and its importance in the banking industry.